One of the biggest opportunities in the stock market is not what to buy, but who is going to be buying it. What you have to understand is that 62% of Americans today, they hold equities. That's direct ownership, mutual funds, or retirement accounts. The equity market participation outside the United States, though, it's only 18%. So 62% of Americans own stocks, only 18% of the international audience owns US stocks. Now, this is subdued global engagement, and it's striking because the scale of the US market means that it should be higher. American stocks make up over 60% of the free float in global equities, yet international investors only hold that 18%. The result is one of the sharpest structural asymmetries in international finance. The world's largest and most liquid equity market is largely untapped by those global investors. And what does that mean? That means it's leaving a vast pool of global capital underexposed to US equities. If those people start to buy US equities, you can expect stocks to go higher. Now, we know this is a big deal because we can go back in history. The Dutch East India Company issued the world's first publicly tradable shares in 1602. See me all the way back in the bag there? The Amsterdam Stock Exchange emerged around the same time, and with it, the modern stock market was born. Some 370 years later, NASDAQ's launch in 1971 was the world's first electronic exchange, and it replaced the trading floor with a computer screen. That compressed costs and it broadened access. It was a big deal for all public equities. But today, according to Binance research, a third inflection point is underway. Equities are being tokenized and traded on public blockchains, and it's migrating away from the centralized ledgers to these open, decentralized infrastructure. And what that allows for is a continuous operation across time zones and geographies. Stock tokenization extends equity market access to a dramatically broader pool of participants. And in emerging markets, fractionalization is not just a feature, it is a critical component of the market. To understand this better, let's take a look at two stocks, SNDK and Micron. Two of the standout beneficiaries of the AI capital expenditure cycle. They have gone up over 600 and 200% respectively just this year. Now, if you go and you take a look at the actual share price, one of them was over $1,700 a share and the other was over $1,000 a share. Yet the average worker across Africa and Southern Asia, they earn below $300 in US dollars per month. That means that a single share of either of these companies represents several months of wages for somebody in these geographies. So if we don't have fractional shares, then these people can't participate in the market. And that is a huge problem for the emerging world. But early data from Binance shows that stock trading reinforces this entire thesis. There is massive demand for broader equity access, and the majority of early adopters are coming from the emerging markets, places where geography and brokerage barriers have historically prevented them from participating. As these exchanges evolve into financial super apps, you're going to get crypto, equities, cash management, everything within a single account. The friction between holding capital and deploying it effectively is going to collapse. And so where exactly are people putting their money now that we're starting to get tokenized exposure in emerging markets? Well, based on some of the early data from the Binance exchange, semiconductors and equipment has emerged as a standout sector. Makes sense. Roughly 1/3 of total fund inflows have gone to this sector, and it is generating about 3 times more trading volume other than the next sector of software and services. Now, this is consistent with a user base that's demonstrating strong financial literacy and market awareness. They're actively allocating across sectors, and they are simply trying to improve their risk-adjusted returns. If we go and look at crypto exchanges, they're moving deeper and deeper into the equity business. You see headline after headline announcing different companies making this move. But the scale of potential impact is substantial. Binance research projects that by 2031, crypto exchanges are going to collectively funnel $2 trillion in incremental capital, and they're going to bring about 300 million new users into global equity markets. And that's just their base case. Now, the reason why that's a big deal is because if there's $2 trillion more and 300 million more people coming into the market, that is a persistent bid that's going to drive stock prices higher and higher. And naturally, if you pay attention to where they're putting their money, those are the stocks that are going to benefit the most. And right now, what we are seeing in the data is that semiconductors, they're popular in the traditional exchanges, but they're also popular with emerging market investors on crypto exchanges. And my guess is that you're going to see a flood of capital coming from the emerging markets trying to get exposure to US equities. And so if 18% of the market is held by international investors, my guess is that percentage is going higher, which means that more capital is coming. In companies like Binance or many other crypto exchanges, they are going to be a massive component of bringing that capital to the market and helping the US economy and US public companies benefit the most.